So the outline is, I mentioned, let me just like mention it once again. We are going to do like we already did the quick introduction. We have 25 to 30 minutes of presentation, and then before going into the like reflection and Q&A, we did like a quick group exercise. It doesn't like, you don't have to use any kind of tools. We are just going to use the Google Meets chat, so no worries about it. And then we are going to like be answering your questions basically. So let me jump right in. So our starting point, I think it's always beneficial to like reflect back and like go back why we are discussing this today. Basically, we know that biodiversity loss is accelerating, but the capital remains stagnant. That's obvious. We know major investors such as development banks and pension funds they are acknowledging the risk, and they kind of say that the ecosystem resilience is important and they want to invest in that. But we also know the current financial architecture is not designed to find a complex system like that is multi-actor and long horizon, such as biodiversity, and that is actually the core of the issue. So when we are approaching the financial institutions, or when we are trying to use the traditional methods of like financing, it just simply does not fit. Like there's a gap that we have to like close, and there's a gap not in terms of the capital, but in terms of thinking approaches and the tools and mechanisms that we have to rethink and reshape basically. So why financing for biodiversity is so hard? Like if you read the delivery 4.1, which we shared like a month ago, probably, we listed many of the reasons why. We say that there's too many indicators. Like, so biodiversity isn't like a one KPI like carbon, and it's not like a one KPI that we can track easily. So too many indicators. It is very local. It can be very context specific. There is no way to like easily standardize risk or impact. So each FI or each different kind of stakeholder has to look into in very depth the context and contextualize what it means actually. So the third one is also very important. Data arrives very slowly. It can be seasonal. It can be collected manually. It can be non-digitized. It can be not long-term. These are all like keywords that are actually very scary to a financial institution if you think about it. Even in the traditional way of you do agricultural finance, sometimes seasonality and like the manual data collection becomes problem. And even in a context such as biodiversity, it becomes even harder. Four, verification is obviously expensive because it requires field checks and it requires multiple stakeholders, and there's a level of like the accountability problem. So who confirms that the metric is real? Some of these issues we are already like addressing with like geospatial data. We are also talking with like certification. So some of them we are already like talking about, but just from the perspective of financial institutions or the finance world to be general, these are all issues that are creating huge barriers for them to enter into biodiversity market. So what we are trying to understand is, what if, especially from the perspective of programmable finance, what if there was a new way of finance that is capable of making payment, disbursement, and interest decisions with much more complex and multiple data? So this question is actually at the heart of what also like Umut was describing throughout his career, but it's also a question that we have to answer probably, or have a like a nice applicable answer, and then adapt it to biodiversity. And that is actually what we now call programmable finance. Programmable finance is sometimes also known as programmable money, like they are used interchangeably, although money is much more about like, so there's a slight difference, but programmable finance is what we're going to stick to. But it only means that like financial flows that automatically execute when predefined and verified conditions are met. What you are trying to basically build is a system, and financial system, that is able to collect verified data to feed the contract and kind of create a system money moves only if the conditions are satisfied, and it becomes an automatic system to execute the loan, the interest rates, or if the payment is going to be made or not. So we are trying to create a system where money is able to move when a certain KPI is hit or a certain condition has been met, and that's what we mean by programmable finance. If you think about all the rest of the like traditional financing methods, there's always lots of different kind of KPIs that you have to follow for conditions, but the conditionality is not actually automatically embedded in the system. It's probably done in a much more traditional way of reporting. Programmable finance is changing that, and the way it is changing is basically how the money, now becoming more digital, is able to hold those information and kind of create a path to ease all these transactions, basically. So a very easy way to imagine and understand what programmable finance means is like thinking about a smartwatch. So imagine you have a smartwatch and like it's like captures your steps, it captures your sleep hours, it captures if you get your exercise regularly, and it kind of automatically like changes your salary or interest rates or maybe your insurance policies based on those data. So that's what we mean by programmable finance. And the data that you already collect by your smartwatch is verified and cross-checked every time you went to maybe a healthcare provider, basically. So it's not just the data that you have on your wrist, it's also the other multi-stakeholder actors that are involved as well. And the point is here, as if you are hitting your KPIs regularly, you are already getting your insurance change or your interest rate automatically updated. You don't have to do anything other than like doing the thing that you are doing. So that's basically at the heart of programmable finance.
In fact, I was trying looking for this space to give in even the example. Programmable finance, if you look like the definition of the previous slide and also this one is in the same example. It is not just single transaction peer-to-peer event, because what usually we see in the existing financial system as peers, as people, you go to apply for a loan, you get an answer. You do a payment, someone is paying, someone is receiving. So those are single things. And of course, you're going to recognize it is easy to program those with functions. This happens, then this happens, and this happens. However, the real challenge applying programmable finance is when this peer numbers is increased, when you start talking about a whole supply chain or a total impact of millions of transactions. So that also opens a space for data science, which cannot be only solved by functional or deterministic systems, where the machine learning approach jumps in to solve questions. So that was a little bit information. While we are imagining something programmable, it is easy to imagine a calculator, but this is not. This is pretty much like a holistic data processor, which needs to see all the transactions, all the total effects. So you can just tie this idea back to the impact on always the climate, for example, something which may be not related with the rough point of view, but there are deeper, indirect, and longer correlations. So programmable finance is not just a peer-to-peer transaction. A little add to the information. Thank you.
Yeah, that's a great, well, like that's a great additional info, and I can also maybe base this and also add that in this like example of smartwatch, you only see a couple of items that you are seeing on the screen. But if you think about your health, you have too many indicators, and it becomes almost very hard to integrate all these two payment decisions. That the programmable finance, by basically just like Umut was saying, that collecting all the data and doing machine learning, is able to handle the majority of the data at very efficient pace. So you are much more relaxed when it comes to looking into much more different or in-depth different data and finding the data that really matters over the long term. So one thing we also have to say that this is not a passing trend. It's probably going to be the future. Like this is what they basically call as banking 3.0, and it's different in a sense that the digitalization of banking, which we are mostly like thinking about. So banking 2.0 was more about maybe getting your financing from a digital app, or like being able to like connect with your bank teller from a basically like digital tools. Banking 3.0 just basically on like repeating Umut's point of view is in there, is going to be handling much more for big data and much more complex data, and it's going to be able to link those data decisions with the money, and with how the money is basically going to be dispersed. And they're already like JP Morgan, Citi, HSBC, and UBS, like they already have some kind of products and services based on specifically programmable finance applications. So they're already doing like other new brands, which we're going to talk. We're going to like give a one case example of that. And also we see like European Central Bank, Bank of England, Federal Reserve System, and Monetary Authority of Singapore. They already have like some kind of regulations, and also central bank digital currencies that ease digital money transactions. Like they are not finalized yet, but the central bank digital currencies are going to be the way that these programmable finance products are going to be enforced, because the digital currencies are going to underline that whole system. Umut is going to give you much more detail about that. And we also see that through BIS, like the basically the center for all major central banks, the common understanding and agenda is like basically is there, and they're really pushing forward for this future. They have lots of interesting projects which also apply to climate risk with regards to with the point of view of programmable finance, such as project symbiosis can be one example. So they kind of work around this and try to push this way forward, and it's going to arrive really fast. So I kind of want to give you just one example what we mean by this and how it looks in real right now in the world. So basically, this is also a program by JP Morgan. Kinexys is the brand that they do programmable finance under, and they kind of created this system for a if I'm not mistaken, a supplier that did not name. But what they do is basically they're looking all the logistics and IoT data, and they're automating trade settlements. So they're using like IoTs, they're using other kind of like data collection tools. And there are a couple of conditions, and if those conditions are met, suppliers can get early payment, or buyers can pay whatever, like after they see that the goods that they receive are like okay with the and this kind of creates a system that is much more automatic and much more fast for all the stakeholders. The trick here is we don't only use the IoT, or we don't only use the logistic providers data, but we also get other kind of supplier, buyer, or other kind of stakeholders data inside the system as well, because everybody is already using the same one system. And one example is like if notification of the goods are traveled, and if the reference number actually matches the pre-specified number of the buyer, you basically like do the payment at that time. Or if the goods are delivered and the temperature data is in the within the pre-specified range, you also like do the payment directly. So you don't have to do any additional reporting. If it matches already and the data is already captured, you're able to make that payment automatically. So that's what they are basically doing. So giving the word back to Umut one time. So he's going to talk about the railways to the programmable finance and what this looks like from a technological perspective.
Well, if there is a question until now, I will be happy to open. But if we are going fine, I'll just continue. Until now, what you heard was just pretty much the definition of programmable finance and who is doing what. So it is easier, at least in this presentation as a strategy. We believe it is easier to understand what is capable by looking to the rails, by looking to the infrastructure being under development. So those 6 items you hear are actually the subcomponents of programmable finance. A main goal on top is applying a full programmable finance approach to all the lines, but those are the layers you need, the railways that you're going to build. The first one is digital assets. You know that. You heard the first Bitcoin and then the cryptocurrencies. They are very early and private industry examples of what digital assets are. However, central bank digital currencies and stable coins are the ones going to thrive comparing to those early private ones. So basically, this is something mathematically and technologically protected representation of cash money. So digital asset is almost equivalent of money, but in the digital world, of course. So there's a protection we require. Some of them start with mathematical equations. Some of them like they have different approaches, like proof of stakes. But in the end, they are representing the minimum atomic value. And of course, the global high computing capacity is one thing that enabling programmable finance. Thanks to AI, that this has been speed up comparing to any time in the history. So all this capacity is required because if you want to truly apply a holistic approach, understanding that huge amount of data, you need computing capacity. So while on the other hand, you have this computing capacity distributed to the peers in a way organic intelligence is processing, which is, of course, which is also a cost, but from the hardware point of view, it is free. So this today's central capacity is only nowadays increasing the level of understanding a whole the full monetary system that's surviving that with all the combinations of transactions. Robotic process automations for financial events. So this sentence basically tells us that, remember the example I just gave. When you talk about programmable finance, we are not talking about simple peer-to-peer transactions, which basically you can write a function to execute a decision. Meaning that when I'm about to pay something to a merchant, for some reason I have 5% discount, the rule is very simple. Apply 5% discount to the volume. But if you increase this problem to a complex supply chain, where uh, everything is connected to each other and there's recurring circular references in the system, and you are about to lend money to an entity working in, let's say, in the food processing supply chain, buying food from farmers, buying some input from vendors, processing, packaging. When you talk about the impact of this supply chain on climate, there will not be a simple rule that you can write in each transaction. You first need to extract this data, process, and with RPA, with process automation, combined with other data which can be read from telemetry systems, IoT devices, or other events happening in them which are not financial themselves, you should combine them to create financial events, to make them understandable for a high level of intelligence, artificial intelligence. Only then that intelligence can start looking for correlations and apply statistical approaches to make meaningful rules, and then only can that return back to the smart contracts. Smart contracts, being said here, is the other one which is replacing the paper contracts, but which is tied to that smart decisions. So which is a again 2, 3, maybe 4-sided, maybe multi-peer understandings, and defining the commercial relations between the peers. But instead of the terms that we used to see, such like that, I am going to give you a ton of tomatoes and I'm going to get back 20,000 euros. This smart contract has also contained to some level of uncertainty, which is going to be decided on spot. This is the only way of doing that. If you don't have the exact approach, exact numbers in your mind, which is impossible to talk about things going to happen in the future. Let's say the total carbon footprint of a production. If you relate your payment to this, you can write a certain number on a contract. So that means you're going to need a smart contract, but you're also going to need some uncertainty. So smart contracts is the one which makes that possible. And finally, the shared ledger for reconciliation of data, meaning that using the blockchain technology, I'm going to simplify this, a common shared database which cannot be altered by peers, which is not centralized. So it runs on global trust. Shared ledger. In this way, this represents the collaboration on data. And of course, when it is about programmable finance, it also represents collaboration on financial decisions. And obviously, we are very well aware this cannot be left to a single authority, single center. Instead, we need smart contracts. We need the technology to make these decisions, and we will be very happy. We'll be happily accept the results and the happening time. So that means reconciliations, clearance, settlements also need to be done on a system which is that. And finally, of course, an advancement in AI, as you see that the increasing R&D in artificial intelligence now makes it possible to build applications fast and also very responsive, not only just being applications, but they are responsive to data itself, they learn. So let me give you another example once again. When we talk about the goals of biocapital, and if you talk about some reservation of vegetation, for example, if you're looking for the real effect that's happening of a financial decision related to that, you cannot just look to history. You cannot make assumptions. So we need a better approach. We need a telemetry system to learn from the ongoing financial decisions. If we are giving loans to farmers, it's this happening, so the vegetation decreases. Or maybe if we invest in regenerative farming in a way which helps it grows, but maybe it helps growing the wrong type of vegetation. So this is a cycle of learning, and only we have the right machine learning strategy can solve that. So once again, this is not a simple set of rules. It definitely requires machine learning within. It requires continuous telemetry. It requires continuous financial event to be fed and be processed by AI, and in a way, new kind of intelligence to run all this data, and this need to be returned back to the decisions. And this is a recurring cycle of decisions. It's not just something you can write on a paper. So all these 6 items are the railways to programmable finance. When you have these things in place, now and only then it is time to build a strategy on top of that. As the given examples that I just shared, whatever the goal is, has a complexity, even to define, even to read the data related, but it is going to use that component, obviously. So that black box, let's say our algorithm plus machine learning system together is the brain of a robot. And those 6 things you see here, they are legs and arms and all the other body of that robot. So having the theory is maybe imagining about a concept about how should be the mind be, let's say the programmable finance brain, but you're going to see all these elements embodying it. So that's okay for me.
Okay, thank you, Umut, so much. So basically, like, I think you left on a good note. So like, these are basically the railways, and these are the like components that are gonna make this future possible. But as I like Tayfun mentioned, and I kind of noted that once, I kind of want to note it once again. Like, this is all happening right now, but it's gonna scale up very fast. So like, we are gonna see how the future unfolds. But one thing that I want to talk and mention about is basically the system kind of what the system basically does. So the system basically does, it takes a real world asset, a claim or a verified outcome. It can be a KPI, it can be the real world asset, and kind of creates a digital representation of that asset. And then we have 2 different things that we do. One thing we do is that we are programming it, just like Umut just described, and I kind of mentioned it. How this asset is gonna get financed is basically gonna be programmed by a big data computing power. And the second part that happens, which is much more interesting and I think is relevant to our discussion, is it is gonna be tokenized. So it's gonna create a liquidity and fractional ownership. So those tokens are going to be able to like transfer and maybe like appeal to much more of a broader range of financial institutions or maybe investors, because those tokens themselves are going to be doing the financing. So it's this formula kind of is important for us, because when we are talking about biodiversity, like 2 things that we always talk about is one, how biodiversity finance requires conditionality, and we are talking about indicators, KPIs. Should it be asset based? Should it be like performance based, or the practitioner based? So we talk about a lot of conditions. And the second thing that we also talk about is we have to have a long-term asset management point of view, because biodiversity impact is not like you do something and get a result at the end of a year, for example. Sometimes you have to wait for almost 5 years, 10 years. So we have a very long-term horizons. So programmable finance in its nature is going to be able to like solve these 2 problems, because first of all, it's a conditional system, just like we described. And the second of all, it is going to be working with tokens, and it's going to enable like liquidation problem that we also face right now. So how it looks in biodiversity context, for example, programmable, what we mean, we can take habitat quality, pollinator presence, or regenerative practices, and we can encode it as a rule that is linked with the financial transaction, basically. So we are going to say if indicator X meets the threshold Y, it's triggered this financial action. So that's going to be the things that we are going to be working on. The other part, the tokenization part, is so there's going to be each managed landscape. It can be forest, it can be agricultural land, it can be marine land. They had long-term value, and we can like do this like financing without locking capital too fast. So because we can digitize assets and based on tokens to enable transferability when the time comes. So when the first investor comes and takes 5 years, the very long term, we can also find ways to maybe, okay, that initial investor can exit in the year second with the tokens and give those tokens to another related supply chain actor or another kind of investor that might be interested in holding those assets. So it's going to give us much more flexibility with regards to approaching investors, basically. So two examples, and I'm like aware of time, so I'm gonna like skip very fast. But imagine there's a regional agricultural bank in Italy, and they're like looking for sustainability linked loans for smallholder farmers who maintain like pollinator habitats. They already know the baseline conditions, so they know like maybe what the flowering strips have to look like. Maybe they know that there should be no pesticides that has to be used, and they maybe know like seasonal maintenance that they have to be very careful about. So you find that data sources that are able to like feed into those baseline conditions. So you kind of look, okay, which kind of data point is able to provide me so that I can apply this conditionality. And then I kind of work with the smart contract logic. And I say, if flowering strip is meeting my threshold, reduce the interest rate, because I then know that it's actually done for pollinator habitats. Or I can say if pesticide log is empty, so we know that there's no pesticides has been used because the farmer is keeping a log because it's maybe like certified. We can and the satellite check is clean. So we are using like maybe 2 or 3 different kind of data sources. Release a bonus credit, basically. Or no conditions are made. Like we know that the farmer has not been doing their like biodiversity claims as they're supposed to be. We can just like we can just return the loans to base rates, so without they won't be getting any kind of like favorable interest rates, basically. So this is how it can work. And the other side is, which is much more interested with what Umut was talking about when he mentioned like the complexity of the supply chain, and it's going to be multi-stakeholder, is how we're going to do it in a maybe deep tier way, or how we're going to do it and activate it in a supply chain point of view. And the same, let's imagine there's a bank and the bank is like actually running a program with an apparel brand. And the brand has some kind of sustainability criteria for all the goods that they're selling, and they want their supply chain actors basically to be able to fund upstream trees basically to farmers and kind of like reduce their impact, basically. So brand says our metrics are lower water footprint, maybe pesticides reduction, maybe the availability of traceability, maybe knowing that the certification protocols are actually like adhered to, so the certifications are not fixed. These are all the problems that we face in real life. So the bank basically takes all these sustainability metrics and provides different kind of ERP tools or mobile tools for farmers, generators, or any other actors such as traders, and kind of collects different data at all levels. So the farmers submit production data via mobile app, basically. There we know that there's an IoT and satellite tool that estimate water and pesticide footprints. We know there's the generators that who like verify the bale quality for cotton and like they look for traceability. And we know traders are the original ones like who are creating the purchase orders and like keeping track of delivery schedules. So we can take all these different points of data and look into supply chain from a much broader perspective and embed smart contract logic with that regard. And we can say, okay, the water is reduced, the farmer's interest rate drops, pesticide free, so the cotton gin receives an accelerated payment from trader, basically. So we can do multi-stakeholder payments based on the condition of the supply chain through in a much broader view. And this is right now is something of a feature that we are discussing, but I can also say that this is what we are trying to prove through our use cases in Turkey as well. It is much more manual right now. It's not that we are using like too many computational power right now. We are doing it much more in a almost traditional way, I should say. But we are preparing for this future, so it's coming very soon. So Tayfun, please, for your closing remarks.
Okay, thank you, Efe and Umut, for valuable insights. Well, very quick wrap up and also give some perspective from biocapital context. We believe that private finance will scale the moment outcomes will trigger financial decisions. So we believe that private finance will scale the moment any outcome will trigger financial decisions. And despite the backlash through omnibus around Europe, digitalization in financial markets will improve and scale. And also just give you the perspective out of biodiversity. You can use this understanding to incentivize or to give a penalty your tier 2, tier 3 suppliers. For example, if you don't pay your taxes on time, if you don't pay your employees' salaries on time, or you do everything right, these are going to be rewarded or penalized instantly. So programmable finance through data collection seems to be an instant event in the near future. And what that means for us is we are going to change the narrative from a reporting burden to create a programmable asset class through biodiversity improvements. Next slide, please. And in the context of biocapital, what we can unlock through this roadmap is we should focus on standardized indicators and also a harmonized verification model to define trigger conditions. And also, as we explained, we are going to need a guideline for if-then logic within the biodiversity context for risk mitigation, and interoperability with financial institutions infrastructure will be key in our context. So just to wrap up, in this transition period, finance will follow the rules, so it will follow clear conditional logics, and each verified data will have some consequences, either positive or negative. And verified outcomes will be used as collateral, not just reports, but they are going to be risk-reducing assets. And just to trigger some ideas around certification roadmap, as we are currently discussing in biocapital, I think we can try to position certifications as verification as governance tools that money can rely on, because investors are going to need one clear definition of verified outcome, whatever it is, because at the end, proof will drive the private capital. So thank you for your time and listening.